Kia ora, and welcome to the Cotality Property Market Update for Whiringa Anuku, October 2025. Property values in Aotearoa edged up by 0.1% in September, breaking a run of 5 consecutive monthly falls. The national median value now sits at $810,000. The marginal monthly rise should be seen in the context of the 1.6% cumulative drop seen between April and August, meaning it is too early to call the start of a sustained lift. Looking at the main centres, the results were patchy. Over September, Te Whanganui-a-Tara, Wellington values dipped by 0.4%, and Tāmaki Makaurau, Auckland by 0.2%. In contrast, Tauranga saw a 1.3% increase, with Ōtautahi Christchurch lifting by 0.6% and Ōtepoti Dunedin by 0.3%, while Kirikiriroa Hamilton remained flat. A key driver of activity has been the continued strength of first-home buyers, who set a record in September, accounting for 28.2% of all sales. This group is especially dominant in Te Whanganui-a-Tara, Wellington, making up nearly 40% of purchases in Porirua and more than 34% in Wellington City. At the same time, mortgaged investors have returned to the market, with their market share pushing back towards the long-term average of 25%. This resurgence is being driven by smaller mum and dad investors, encouraged by recent regulatory changes like the reinstatement of mortgage interest deductibility and lower mortgage rates, which reduced the size of monthly mortgage top-ups. So far this year, the median price paid by a mortgaged investor is $759,000, down from $770,000 in 2024, suggesting some are finding savvy deals in the current market. Their presence is particularly strong in cities like Kirikiriroa Hamilton and Ōtautahi Christchurch, where they account for 29% and 27% of purchases respectively. The group largely holding back and therefore making way for first home buyers and mum and dad investors are existing owner-occupiers, or movers, who remain quieter than usual. With the spring selling season now underway, the total number of properties listed for sale is 12% below the same time last year, but remains above the 5-year average, meaning the market is still largely in favour of buyers. The major economic news was the Reserve Bank's decision to deliver a supersized 50 basis point cut to the official cash rate in early October, taking it down to 2.5%. This front-loaded easing is essentially a least regrets option from the bank, designed to provide a clear signal to support consumption and investment in the sluggish economy. That, in turn, would help lessen the risks of an inflation target undershoot sometime down the track. Another cut is possible at the final meeting of the year on November 26th. In addition to the OCR cut, the Reserve Bank also announced the loosening of the LVR speed limits from 1st of December. For owner-occupiers, 25% of bank lending will now be allowed at LVRs above 80%, up from 20%. For investors, the high LVR threshold has been increased from 5% to 10% of lending. However, this is not expected to have a major impact, as the current limits aren't really being tested due to the broader cautious nature of the housing market. Looking ahead, lower mortgage rates are expected to support the market, with about 44% of existing home loans available to be repriced within the next 6 months. While provincial areas are showing signs of turning a corner, a new property boom seems unlikely. Although there are now some green shoots starting to emerge, the economic and labour market recovery is still expected to be slow, and the looming restraint of debt-to-income ratio limits are reasons for caution about strong house price growth in the medium term. Stay informed of all the latest developments by regularly visiting the newsroom at cotality.com/NZ, following us on Cotality NZ social channels, and subscribing to New Zealand Property Market Podcast on all good podcast platforms. Mā te wā.